Hello and welcome to OnPoint, a podcast series covering fresh thinking on the big topics shaping business globally. I'm John Briggs, Global Head of Economics and Market Strategy at NatWest. In this episode of OnPoint, I speak with Thomas Knudsen, CEO of global logistics and shipping leader Toll Group, and NatWest Chief China Economist Peiqian about the future of supply chains and what companies can expect in the post-pandemic economy. Thomas, 2 years after the pandemic first hit, global companies are still dealing with massive uncertainty and supply chain issues. Can you give us a broad state of the world from your perspective, from where you sit, what you see? What are the big challenges that remain, and are we ever going to get back to having, normalcy on a daily basis?
Thank you for the introduction, and if you allow me, perhaps a little bit walk down memory lane to what actually happened, because I think that will also inform the conversation going forward. So when COVID hit back in February 2020, what we saw was a massive withdrawal of capacity in the shipping industry due to concerns about a global recession, which meant that container orders were canceled, ships were not being ordered and so on. And very, very quickly, that changed massively into a great demand spike, especially in North America, initially driven by the shipments of PPE, and then subsequently by a demand spike in the US, driven by partly stimulus checks, and I think partly from work from home, thus furniture, bicycles, Peloton, what have you. At the same time, in the air freight industry, what we saw was that many years of underinvestment into cargo airplanes had really relied on the passenger airlines to move cargo around. So massive increases in passengers had led to using the passenger planes to move cargo. But when that dropped off, suddenly you had a large gap in air freight capacity, because you simply didn't have the cargo capacity of earlier years. And there were also other long-term impacts, such as the average age of a truck driver in the US now being in the mid-50s, and not very different in markets like Australia and China for that sake, but also in Europe, where a number of things, including Brexit, meant that people were returning back to perhaps Poland and so on. So I think it's fair to say that COVID was the lighter that lit the fire, but it was a number of things that suddenly came together. Shipping lines have benefited massively in this and have invested heavily into building ships. That will take a while. We expect that there will be significant ships capacity delivered into 24 and 25, some into 23, but especially 23 will be tempered by ships being scrapped and so on. So we actually believe that the demand side, and that's the big question mark, will probably be a relatively low growth, but the supply chain of ships is easy to manage for the shipping companies, and they've made more money over the past 2 years than they have the past 20 years. So they have little interest in throwing in a lot of capacity. With airlines, they are building cargo airplanes, and as travel comes back, we think that will help a little bit. The bottlenecks right now about lead times and transit times. So because ships are being delayed because of bottlenecks in ports, lack of automation, more cargo has been moved on to airlines, and therefore you've seen this inflation pressure that started in shipping has now gone into air freight, and having a very negative impact on overall cost and an impact on inflation. So if I look ahead, my view is that over the next probably 12 months, we will see minimal let up on the supply chain challenges we've seen over the past 2 years, in particular North America and in Asia.
Thanks, Thomas. It's good to have somewhat of a time frame. And Peiqian, this is where I'm going to bring you in, because we've got, as Thomas mentioned, we've got the supply side of the equation and the demand side of the equation. But sticking with the supply side of the equation here, you've obviously done a lot of work, as I mentioned, on supply chains, regional breakdowns, and all of that. Particularly important is where that work crosses over with your work on China. So, given, what do you think are the main challenges, given your insight on China, but then within the framework of, China's zero COVID policy and initial optimism amongst many that they would be relaxing that in the latest lockdowns, but not seeing much on that side. So when you think about some of these bottlenecks that Thomas mentioned, do you think that for at least in my mind, China's zero COVID policy is clearly related, and that injects a great deal of uncertainty in its own right. Do you think that that's ever going to ease, or and then also in general, what are your thoughts on some of the supply issues?
Thank you, John, for having me today. And that was a big topic for me to start with. I'll just break down that to slightly smaller topics. Firstly, just to identify the bottlenecks of supply chain, which was the first lead question. I think we have done some work last year on the supply side, identified 4 major areas of bottlenecks that's happening in the post-pandemic recovery. That's been, firstly, the shipping and logistics, as Thomas has mentioned comprehensively earlier. We also think that, a semiconductor sector shortage was contributing to the broader bottlenecks in electronics goods production as well. And on top of that, we also face more raw materials, energy shortages, more acute this year when, we had this Ukraine crisis outbreak and as well as an unexpected lockdown from Shanghai, which are all adding up to the problem of bottlenecks. And finally, we're also seeing labor shortages. I think Thomas mentioned about that too, a lack of truck drivers in North America. And now because of COVID lockdown, lack of factory workers near the manufacturing hubs in Shanghai, they are all contributing to the supply chain problems. And then the second topic of China's COVID policies and its uncertainties to global supply chain. I think we can just break down this view to short-term and long-term concerns. On the short-term basis, it's very visible that Shanghai lockdown is leading to physical disruptions to economic activities. People are locked down at home, and physical economic activities can't proceed as normal, which is having an outsized impact on China's economic growth as well as supply chain in April, as evidently shown in various data leaks, from supplier delivery time to production, even to consumption. And in the medium term, I think Shanghai's lockdown is a significant turning point because prior to that, market was expecting China to embark on a gradual relaxation of COVID policies in line with global policies. China might be delaying in reopen, but will still be on path to reopen because we have seen that China is also catching up with vaccination rates, having tiered management, especially in Shanghai, to avoid any sort of lockdowns. But the lockdown has changed that expectation. In the medium term, it looks like zero COVID strategy is just here to stay for the next couple of months at least. And we're dealing with a more highly transmissible Omicron variant of COVID compared to the initial outbreak. So that means future lockdowns to avoid outbreak of COVID is just going to get more frequent, more drastic, and that's going to cause medium-term uncertainties for corporates. So that does not only dampen the production plans and does not only lead to longer supplier delivery time, but more worryingly, I think it's going to dampen business sentiment for further investments and expansion in China as well.
Thanks, Peiqian. And you and I have had conversations with corporate leaders out here in the region, just how it's not even just about what the port open or not open or rail capacity or road capacity, but the ability to move product or intermediate goods within China is also affected. So the ripple effect is that even if you see Shanghai opening up, it doesn't necessarily mean that a lot of those internal supply chains are freeing up. So it doesn't sound like there's a huge amount to be near-term optimism on either side from either of you. But Thomas, I'm going to turn back to you. I want to move a bit from the macro to the micro. So you deal with companies all the time and discussions about how they're adapting to this new world, this long-term uncertainty, this lack of, as you've indicated, capacity in much of the shipping world until perhaps 2024, 2025. How are companies adjusting to this? And then a slightly different but important question to that is, how do you recommend corporations or companies start thinking about this, given the new environment, which might be with us longer than many hoped?
I think there's probably a couple of things that we see happening in the market today. So one is that COVID has changed consumer habits. So in consumer-driven industries, retail, groceries, and so on, what we've seen is a change to more B2C, the e-commerce boom, and that's driving a greater need for being close to the final consumer. So that's driving certainly a decentralization of distribution networks, both in Asia and in the big markets, North America, Europe, and the US. So I think changes in consumer behavior is driving supply chain changes. The other thing is this supposed change from just in time to just in case. And whilst that is I think a trend that we're seeing, it's also fair to say that it doesn't mean leaving just in time behind. I think it's as big a conscious decision-making process around where you source your product from, perhaps having more locations to source from, less reliance on a single source of dependency. And what we just heard about China is a good example of that. And I think the easy choice is often people moving their supply chains, let's say, to Vietnam, Indonesia, or China, Southeast Asia. But reality is it doesn't necessarily help solve the problem, because so much of the sub-manufacturing takes place in China, and that then leads to problems further down the road. So I think there's undoubtedly a trend towards sourcing in Southeast Asia. But it's a very difficult one because they are so reliant on China still as a component manufacturer in the Asian context. Plus the supply chains with the challenges we're talking about today is making it harder to source out of those areas into Southeast Asia. So I do think that there's a number of things that businesses are doing, holding more inventory, having more diversified supply chains, using more modes of transport, accepting additional cost, but also some that are demand driven by customers, really adapting their business models to them. They're actually conflicting, right? Customers are asking for delivery of product faster, more reliable, and cheaper. And at the same time, the global supply chain is going the opposite the way, with more bottlenecks, with slower lead times, with increased cost. So that is, I think, going to be one of the themes for the coming years, this almost a conflict that we're having in the supply chain between customer demand and what we can actually deliver on behalf of businesses.
Okay, you really went to one of the points that I want to kind of get into next, which is, making this idea of supply chains more resilient, because from a macro level, you just assume that it's going to be, okay, well, it just means everything's more expensive. But some of the stuff that I've heard is actually that, as you kind of indicated, companies are going to start kind of or breaking that down to some extent. But given the cost and inflationary impact that affects everybody from corporation to consumer to investor, this is what I want to narrow in on. So do you feel like corporations are going to, if corporations make some, or maybe not all, but part of especially the critical parts of their supply chain more resilient or more diversified, there's obviously a cost implication there. But do you think that that's going to be more narrowly applied to supply chains, or companies are going to be more cautious, defensive, and so we just see a larger scale of cost implications going forward?
I think there is going to be a broad increase in cost, not just about supply chain and going further. I think the secret in the conversation we are having with our customers is how do you manage that? So I don't think you can have full-scale agility and resilience across your entire supply chain, across all your product lines, but you need to be really, really deliberate on saying where do you have specific customer needs or product which is critical for the manufacturing. And that's not an easy solution. I'll give you an example where we've got a lot of trucks waiting to be delivered in different markets, and we're missing the window wipers because we're missing that final part. So we're having a $200,000 truck not being delivered because we're missing a $25 component. So it's not as easy as just looking at value and where the supply chains work. You really need to dig deep, and I think that's probably one area where we haven't seen global businesses in general. There are some who do it really well, but really understanding truly their dependencies. It's coming out through pain, where it's suddenly being revealed that there is a supply chain bottleneck, but the hard work of actually identifying it before it happens and building the resilience proactively is probably an area where I see opportunities for most businesses to improve.
Yeah, and probably improve share too. So just one more on this train of thought, Thomas. again, when we think about the longer term inflationary impact, and this is more than just trying to work through the next year or two, and what kind of inflation are we looking for? A higher inflation, higher cost world 5-7 years down the road or not? So some of the changes and adaptations that you've just discussed, do you see these as like an ongoing multi-year cost pressure, or are we going to have kind of a few step functions and then a new equilibrium down the road where we've had some cost increases, but then we've come to a new balance? Or is this just going to be an ongoing pressure as companies adapt, as supply chains become more diversified, as they try to relocate to other regions? The medium-term view.
Yeah, if you're looking 5-7 years out, I actually think there's a high risk that this is going to last. Shipping lines have made a lot of money, and I don't think they're going to give up quickly on the average rates that they've secured. They've signed a lot of long-term contracts with customers that have not been in place before, and that puts a floor to pricing. I think the same thing applies for the airline industry. So certainly in supply chain and logistics, I think there are indications that this is something that would last. I also think that some of the fundamental areas of the economy in terms of inflation and so on will be sustained broader than that, because the resilience will have to be built in. There are going to be additional inventory in supply chains as a result of the geopolitical challenges we have. I think the transition into sustainable supply chains has not really started happening yet. The last 2 years, there's been a lot of discussions on it. But if you look at the cost pressures there will be in transitioning, for instance, heavy vehicles into hydrogen and electric, the next 5 years, that will be very expensive. A hydrogen truck today is anywhere between 5 and 7 times as expensive as a diesel truck. So if regulatory pressure ramps up in this specific area, I do think that could have a massive impact on cost in the broader supply chain and thus on businesses. And I guess the focus on sustainability is not just limited to the supply chain, but other parts of business or logistics, but other parts of the supply chain. And therefore, I could see inflationary pressure remaining quite strong based on that, at least.
I'm going to go back to Peiqian for a minute and talk about the demand side. So, your expertise is here in the region, obviously, given its importance, not just to global trade, but, with China being the second largest economy, these lockdowns hurting demand, which have some impact on commodity prices, at least the outlook for them. But can you just comment a little bit on, your medium-term growth outlook for China and for the region more broadly?
Yeah, sure. So from a demand angle, I think, China has been the largest trading partner, or the second largest to 90% of the countries in the world. So obviously, China's demand matters because of its sheer size. And this lockdown that we have observed right now and its uncertainties over medium-term policies is definitely going to weigh on China's domestic demand. So that's inevitably is going to lead to some extent these inflationary pressures in a rising inflationary environment. But how far will that be? Will China be, re-leveraging the economy with massive stimulus again? We think that, as sentiment remains weak, it's very likely that, or it's necessary for China to step up with more stimulus. But in our forecast and outlook, I think that any stimulus will be much less compared to what we have observed in 2008, 2009 type of infrastructure revamp, or 2015 type of property sector boom. So yes, we do expect some sort of stabilizing counter-cyclical policies to stabilize China's demand, but stimulus will be coming in smaller sizes. So that means, broadly in the medium term, China will still be under this secular slowing down momentum as China shifts from a high growth rate regime to a higher quality of growth, but lower growth rate regime. So that translates into Asia broadly as well. Even Asia remains a critical engine of global growth, but the contribution to global growth might be stabilizing at its current level right now without much further room for rebound, without China being the main engine to growth in the region. But that doesn't mean Asia will be left out in the global growth, because we think that, in the region, in the very short term, the regional economies may face headwinds from higher inflationary pressure. And, they might face a trade-off between managing inflation by tightening at the expense of slowing the growth. But post-pandemic, we still expect Asia to recover and be one of the key global drivers for growth. But growth and recovery of supply chains might be coming in a different form after the pandemic. So our medium-term outlook for Asia will be, instead of a much deeply integrated supply chain that Asia has already enjoyed in the past few decades, to a new regime of global supply chain outlook that revolves around new trading blocks, such as the signing of CPTPP, RCEP, and these kind of trading partnerships will perhaps be the new engine and driver of growth, as well as the new supply chain diversification landscape.
It'll be interesting to see if some of these dynamics that are brought up by both you and Thomas, the relocating or potential attempt to relocate certain supply chains then falls along some of those trading blocks or, alliance-led groupings. So lots to move there. So Thomas, I'm going to turn back to you. And here's a plug for you. I recently listened to you on a podcast called Crisis Talks, and I highly recommend it for anybody to look it up on Spotify and give a listen. But you had a lot of really interesting insights about crisis management, leadership, purpose. The topic in particular that struck me, well, a lot did, but just more relevant, perhaps to our audience now, is the crisis management time of things, and going through the myriad of issues you face, not just during COVID, but not just COVID related. So, if you could share a little bit at a time of where it feels like we're almost in constant rolling crisis, or the overall large crisis we face has spurned lots of new ones, and then geopolitical issues and everything that we're facing now. What did dealing with COVID and your own company's issues, notably, for example, the cyber attacks, teach you about crisis management and how, as you put it, crisis addiction?
Yeah, thanks for the plug. As the famous philosopher Mike Tyson once said, strategy goes out the window when you get hit in your face. And I think that can be an excuse for not always planning or managing risk as well as you could. So I a few weeks ago looked at our risk map from 2018 and 19, and in that risk map we had geopolitical tensions, we have hyperinflation, we had a global pandemic, we had cyber attacks. So when people talk about black swan events, I think it's fair to say that whilst clearly some of these came in as surprises, we had identified these risks early, but we had done very little to mitigate. And I think my reflection was probably that we hadn't spent enough time on thinking strategically about risk and risk mitigation up front. And the second part then, as you talk about the addiction to really being in crisis, is that whilst it sounds counterintuitive or wrong, but a lot of people actually enjoy crisis and managing through crisis. It becomes, you're looking for the next problem and the next problem to solve. Everybody gets into a room, you work till midnight, you get some victories, you turn something around. And it can easily become the way of operating a business. And I think it is critical that whilst you clearly need to solve the problems as they emerge, that in leadership, you step back and say, well, what's coming at us? How do we think differently about resilience and agility? So there are some businesses that have managed COVID and supply chain challenges really well. But I wonder how many are using the insights they've gained over the past 2 years to think 3 years out and really forecast what could happen and how to mitigate them, and potentially being willing to put some money on the line to mitigate that, rather than saying, well, if we have the next whatever bottleneck that happens, we'll have to deal with that when we get there. So I think this idea of both thinking more deeply around risk management, and being willing to accept additional cost, and at the same time being really cautious about not getting addicted to managing risk and focusing on being really good at managing problems as they happen, but really stepping back and looking forward. And I think you often learn the lesson when you get hit in the face that you needed to have done both.
Thanks, Thomas. So I think we're going to turn now to Q&A. Like I said, we've got some pre-submitted questions. First one's for Peiqian. China seems to be very stubborn about policy easing in the face of weak growth. How can they achieve their growth target without more stimulus? Is pushing the currency weaker one option?
Thank you, Joe, for this question. Well, the short answer to this is they cannot. In fact, our forecast for growth is also slowing down. We have changed our forecast to 4.1% after the April data disappointed on the downside, which is pretty far from the government's target of 5.5%. So in our view, I think the policymakers are currently facing a policy trilemma. They're trying to balance among three policy goals, namely maintaining zero COVID strategy, maintaining a stable debt accumulation pace, as well as achieving a 5.5% moderately strong growth rates. In our view, they have to give up at least one to achieve the other two. So we think that it's very likely that China will miss its growth target, but still maintain the other two policy goals. As for the second question you were asking, is pushing currency weaker one of the policy options? In our base case, it's unlikely that the policymakers will be using a weaker yuan to lift exports competitiveness, because in the past 2 years, we have observed that China's export outperformance was not because of a weaker yuan, but rather yuan was pretty strong on a basket basis, and CFEX has even touched multi-year high of 106 before coming off in the past month to around 100 now. So the weakness we have seen so far, in our view, is more likely a one-off adjustment to be in line with fundamentals on a basket basis. As we mentioned, that CFEX has been normalizing to around 100. So that's within our expectations of a medium-term range in 96 to 102 as well. So our forecast for dollar CNY is that it might be still weakening on a weaker sentiment because of lockdowns, weaker investment and consumer sentiment in the short term. Might even hit 7 in the next 2 months, but it will still normalize by end of the year to around 675.
Thanks, Peiqian. And then a question for Thomas. You referred to this a little bit, but when you look at just about any sector in global economy, transport contributes a large amount of their carbon footprint. You know, you can go sector by sector, but it's always a piece of the puzzle. What can be done to make supply chains more green? Broad question.
Yeah, and I think there are multiple levers that we can pull in that context. I think very short term, because I think it's important to realize that some of the changes that we need to make will take a long time to affect. So if we need to, for instance, use alternative fuels on ships, we have a lot of ships that are 2, 3, 5 years old, and they will still be in service in 10 or 15 years. So transition into some of the new fuel sources will take us probably effectively 10 to 15 to 20 years. So that's a long journey. Similarly, on road transport, we simply don't have a pipeline of vehicles to help. So Amazon a couple of years ago announced that they were buying 100,000 electric trucks from a well-known Chinese manufacturer. They've just pushed that back because they simply haven't had a single one delivered now. So there's technology issues about heavy EV in trucking. Hydrogen is clearly an opportunity, but as I said, at a price point which is 5 to 7 times as high as diesel, that's unlikely to happen. So I think if you look at it in terms of some of the macro levers we have on equipment, that's really difficult to do in the short term. There is still plenty of opportunities to rationalize and optimize supply chains, improving efficiency and productivity of the assets that we have, increasing utilization of the assets that we have, especially in warehouses and trucks and so on. So there's a lot to be done there. And on the technology side, getting better at predicting demand and using your assets accordingly. I think that the industry is behind what we see in other areas. So I think there are things we can do in the short term to improve, but the real fundamental change will probably only happen post 2030 when we start using potentially nuclear power and chips. That will come 2035 if the regulatory environment will be ready. But if you look at other areas such as ammonia and parts of natural gas, that's only really likely to impact the industry post 2030.
I hope you've enjoyed this episode of OnPoint. Please do subscribe to our channel to get future episodes and navigate to www.natwest.com for the latest updates on what's moving markets. We also encourage you to follow us on social media to get all of our latest content. Speak to you again soon.